Imagine landing your biggest corporate clients ever. Like just watching your product demand absolutely explode by what, 400% in a single vertical.
Oh, yeah, it's unheard of.
Right. You're building up this record $8 billion backlog, and then you just sit back and watch Wall Street completely punish your stock.
Yeah, it's brutal.
Because, technically you made less money doing it. I mean, welcome to the paradox that is Carrier Global Corporation's Q2 2026 earnings report.
It really is the ultimate diagnostic puzzle right now. For anyone trying to, understand industrial supply chains, this is it.
Totally.
You look at the top line, the sheer volume of product being ordered, and it just looks like a company entering this golden age.
Oh, for sure. On paper, it's amazing.
Right. But then you look at the bottom line, the actual profit margins, and you see immediate, just painful friction.
Yeah, and that's exactly why we're doing this. So welcome to the Special Talk Tickers edition of our deep dive. We are thrilled to have you with us today as we break down Carrier's Q2 2026 earnings call.
Specifically tailored for you, the retail investor, because, making sense of this market is tough right now.
It is. It really is. And if you track the ticker, that's TARR. The mission today is to, look past the superficial headlines. We want to unpack the actual mechanics of what is happening inside one of the world's largest manufacturing giants.
Because reading a headline is just dangerous in this environment. I mean, a headline tells you what happened, sure.
Right, but it doesn't give you the full picture.
As an investor, you only make money by understanding why it happened. Mm-hmm. And more importantly, how the underlying mechanisms of the business will actually adapt to it going forward.
Yeah, that's the actionable part. So this discussion is going to be fast-paced, it'll be data-forward, and we are strictly focused on the 4 things you need to know. The headline numbers, the real story behind them, management's guidance, and obviously the actionable bottom line.
Let's get right into it.
Let's start with the hard data, the headline numbers. For the second quarter of 2026, Carrier reported $6.4 billion in sales. That represents a 3% organic growth rate.
Which is pretty solid.
Right. But before we go further, let's establish exactly what we mean by organic growth, because I swear, companies just love throwing that term around on these calls.
Oh, they do. They do. So organic growth is basically the purest measure of a company's internal engine. It strips out all the noise.
It's like acquisitions and stuff.
Exactly. When you look at total revenue growth, that number can be, artificially inflated. If a company just went out and, say, bought 3 smaller companies that quarter, their total revenue jumps.
Right, but that's not real growth from their core products.
No, it's just buying revenue. Or, it can be skewed by foreign currency exchange rates bouncing around. Organic growth removes the impact of those recent acquisitions, divestitures, currency swings, all of it.
It's the real baseline.
Right. It tells you, did the core business as it existed last year actually sell more volume or, command better pricing this year? And honestly, 3% in this specific macroeconomic climate for heavy industry, that's solid.
Okay, so the core engine is moving forward. They hit that $6.4 billion in sales, and they actually beat Wall Street expectations on the revenue side. But here is where the story just completely derails.
Yeah, the earnings.
Yep. Adjusted earnings per share, or EPS, came in at $0.86. And the adjusted operating margin was 17.2%.
And look, management was very candid on the earnings call. They didn't hide it. They flat out stated that a 17.2% operating margin was a disappointment.
Yeah, and they really owned it.
They did. They were not trying to spin that particular metric at all. And furthermore, that $1.86 EPS, that actually represents a 7% decline year over year.
Okay, wait. Stop right there. Walk me through the math of that because it doesn't make sense on the surface.
Yep.
Sales beat expectations. Organic growth is positive at 3%.
Right.
The revenue pie is getting bigger. So how exactly does a company push more product out the door, bring in more billions in revenue, but somehow watch their earnings per share just drop by 7%?
So the answer lies in the composition of that revenue pie. Bringing in cash is not the same thing as keeping it,
Yeah, gross versus net.
Exactly. To understand how a, multi-billion-dollar industrial giant can suffer this kind of margin squeeze right in the middle of a massive demand boom, we really have to look at the operational friction.
Friction on the factory floor, right?
On the factory floor and in their supply chains. So let's look at the order book.
Oh, man. The order book is where things get truly wild this quarter. So total company orders were up about 40%. Commercial HVAC, which is, the heavy-duty industrial climate control systems, up a staggering 65%.
It's massive.
And the catalyst driving this entire wave, everyone probably guesses it, it's data centers.
The scale of the data center impact is it's completely reshaping their entire business model. Carrier noted that orders specifically in their data center vertical were up 4 times over last year.
4 times the volume in a single year. That's just absurd growth for an industrial hardware company.
It is. It's tech level growth.
And that is what's fueling this record company backlog. So excluding the long-term agreements they have locked in, their total backlog is now over $8 billion.
Which is wild. An $8 billion backlog functions as this massive financial shock absorber.
How so?
Because it provides incredible visibility into future revenue streams. I mean, they aren't sitting around guessing what they will be building 6 months from now. They already have the orders in hand.
Right. The checks are basically written.
Exactly.
Right.
But getting back to your core question, like, why are profits down when demand is soaring like this? Well, we have to look at the difference between what they are putting into the backlog for the future and what they actually manufactured and shipped out of the factory this specific quarter.
Okay. Management blamed something they called an unfavorable mix, which frankly just sounds like a really polite Wall Street way of saying, we sold the wrong stuff.
That is the mechanical reality of industrial manufacturing, yeah. Not all products are created equal on the balance sheet.
Right.
When you manufacture this vast array of equipment, the profit margin varies wildly from unit to unit. You know, you might sell a massive commercial chiller at a 30% margin, but then a basic residential component at a 10% margin.
Okay, that makes sense.
So this quarter, Carrier experienced a huge surge in overall volume, but a totally disproportionate amount of the physical units actually leaving the loading docks were their lower margin products.
Let's use a restaurant analogy to visualize this because I think it helps. If a high-end steakhouse is completely booked for the night, the gross revenue looks fantastic on paper, right?
Sure, packed house.
Packed house. But if every single customer who sits down only orders like tap water and cheap mozzarella stick appetizers, the restaurant's profit margins are going to collapse.
Oh, absolutely.
They still have to pay the waiters, keep the lights on, pay the rent, but they aren't moving the $100 dry-aged steaks that actually cover those overhead costs and generate the real profit.
That's a great way to look at it.
The dining room is packed, but the mix is terrible. So mechanically, in Carrier's case, what exactly were the mozzarella sticks and what were the steaks?
All right, let's break down the appetizers. They sold way too many of this quarter. We can actually look at this across 3 distinct segments.
Okay, what's the first one?
First, in Europe, they saw very strong top-line growth in battery and solar technologies. Now, selling those units drives up the $6.4 billion revenue figure, obviously.
Right, it adds to the top line.
Yeah, but historically, those specific products carry much lower profit margins for Carrier compared to, say, their advanced heat pumps.
Okay, so that's Europe. What about the next one, their transportation segment, I think?
Right, in their transportation refrigeration business. And just for context, this is the segment that builds the cooling units to keep food, pharmaceuticals, sensitive chemicals cold during transit.
The refrigerated trucks and stuff.
Yeah. So they sold a massive volume of shipping container technology. Sales of container refrigeration units were up 40%.
But wait, how does selling 40% more shipping container units hurt them? I mean, a sale is a sale, right? If they're moving more volume, shouldn't they be making more money?
You really have to look at the margin profile of the specific asset. Shipping container refrigeration units are essentially commoditized hardware.
Oh, so they're cheap.
Yeah.
Yeah.
They are sold in massive bulk to these global shipping conglomerates who just negotiate razor-thin margins. The stake in this division, to use your analogy, is the global truck trailer refrigeration unit.
Why are those so much better?
Because truck trailer units require much more specialized service networks. They have completely different life cycle economics, and they command a significantly higher profit margin for Carrier.
I see.
But this quarter, while those cheap container sales surged 40%, their high-margin global truck trailer sales were actually down in the low teens.
Oh. Okay, so they sold thousands of low-margin shipping containers, while the high-margin truck units just sat in inventory. That makes total sense. What was the third segment hitting their margins?
Their core residential and commercial business right here in the United States. Basically, they saw a higher mix of units sold for new construction rather than replacement units.
Okay, I really need to understand the economics of that.
Yeah.
A 5-ton residential AC unit is a 5-ton residential AC unit, right? Whether it's going into a brand new house or an old house.
True.
The metal, the refrigerant, it costs the exact same to manufacture. So why does the destination change the margin so much?
The physical unit is exactly the same, but the leverage in the sales channel is completely inverted. Let's look at the mechanics of a new construction sale.
Okay.
If you are a massive national home builder like Lennar or Toll Brothers, and you are constructing a subdivision of 1,000 homes, you are negotiating your HVAC contracts quarters in advance.
And you're doing it directly with the manufacturer, right?
Yeah. Directly with the manufacturer or a primary distributor.
Yeah.
You are buying in extreme bulk. And because of that volume, the builder has all the leverage. They squeeze Carrier for every single penny of discount.
Oh, wow. So Carrier just takes a haircut on the profit.
Yeah. Carrier accepts the lower margin just to secure that guaranteed volume and, the future parts revenue down the line.
But the replacement market is different.
Completely different. Think about it. If your air conditioner catastrophically fails in the middle of a brutal July heat wave in Texas,
You have zero leverage.
exactly. You are not negotiating bulk discounts. You call a local independent dealer, you are probably sweating and panicking, and your only criteria is, can you install a new unit by tomorrow morning?
Right. I don't care what it costs, just fix it.
And that local dealer relies on the immediate availability of inventory from Carrier's distribution network. So because of the urgency and the localized nature of the sale, Carrier and their distributors command a drastically higher profit margin on that emergency replacement unit.
So this quarter, the national home builders were basically buying units in bulk at heavily discounted rates, but fewer homeowners were panic buying emergency replacements at premium prices.
Precisely. That shift in the ratio, more new construction, less replacement, acts as this heavy drag on the overall operating margin, pulling it all the way down to that disappointing 17.2%.
Okay, that covers the unfavorable product mix.
Mm-hmm.
But there was another major headwind dragging down the earnings, and it has to do with tariffs, right?
Yes. This is a textbook example of supply chain timing friction. In early April, new tariffs went into effect on certain raw materials and imported components that Carrier relies on to manufacture their units.
Which means their cost of goods sold, their KGS, just spiked overnight. The metal, the compressors, whatever components were hit by the tariff suddenly cost Carrier more to acquire.
Yes, exactly. And the logical response for any manufacturer facing a sudden increase in KGS is to just pass that cost along to the end consumer by raising prices.
Right, which Carrier did.
They did exactly that. They announced price hikes to offset the tariffs. But here's the mechanical issue. You cannot instantly update the pricing on every single contract globally.
Right, why not? If their costs go up on April 1st, why can't they just charge the distributors more on April 2nd?
Because industrial sales involve massive networks of distributors, They have pre-existing quotes that are valid for 30 or 60 days, and these long-term supply agreements.
Oh, so they're locked in.
Yeah. When Carrier announces a price hike, it takes time to physically flow through the channel. They didn't actually implement the price hikes until late April. And even then, it takes weeks for the old, lower-priced inventory to flush out of the system.
Before the new price sheets actually become the standard.
Exactly.
So for a period of several weeks in April, and likely bleeding right into May, Carrier essentially just had to eat the cost of those new tariffs.
Pretty much.
They were paying the higher material costs, but still selling at the old, lower prices.
They absorbed the blow entirely on their own balance sheet. Now look, over a 5-year horizon, a few weeks of eating tariff costs is just a blip.
Right.
But when Wall Street measures your performance over a rigid, arbitrary 90-day quarterly window, that specific timing lag takes a very visible, very painful bite out of the margin.
Yeah, that's the danger of quarterly capitalism. Okay, so we've established that management is unhappy with the margins, but they aren't just, shrugging their shoulders and giving up.
No, not at all.
They made some massive strategic moves this quarter to address the future of the company. I really want to start with the acquisition they announced. They bought a company called 75F.
This acquisition is really the key to understanding Carrier's pivot from being just a legacy hardware manufacturer to a full technology ecosystem. They acquired 75F to expand their total addressable market, their TAM, by roughly $20 billion.
Expanding your addressable market by $20 billion with one single acquisition is a massive claim. What exactly is 75F?
So 75F is a company that specializes in building management systems, or BMS. But it's not a legacy system. It is a cloud-native, AI-enabled platform specifically targeted at small to medium-sized businesses and international markets.
Okay, to understand the significance of that, I think we need to look at what Carrier's footprint actually looked like before this acquisition.
Good point. Historically, Carrier's existing building management platform, which is known as ALC, has been highly engineered for massive, complex, large-scale applications, mostly in the U.S. market.
Like what?
We are talking about skyscrapers, massive hospital complexes, university campuses, systems that require extensive custom engineering and, huge on-site servers.
But the vast majority of commercial real estate isn't skyscrapers. I mean, it's strip malls, 3-story medical offices, local bank branches.
Right, and historically, those smaller buildings couldn't afford $1 million custom BMS. They just use basic programmable thermostats, which are incredibly inefficient.
Oh, so 75F scales it down.
Yes. 75F allows Carrier to seamlessly step down into that small and medium building space. It basically opens up millions of square feet of real estate that previously had no smart efficiency management at all.
The CEO, David Gitlin, said something on the call that really caught my attention. He talked about how 75F enables agentic AI applications.
Yeah, that's a big phrase.
Right. Now, in the tech world, we hear AI thrown around constantly, like everything has AI now. But what does agentic AI actually mean in the mechanical context of a commercial air conditioning system?
It represents a fundamental shift in how buildings consume power. So think about a traditional smart thermostat. It's reactive. It senses that the room is 75 degrees. You set it to 70 degrees. So it turns the air conditioner on until the room hits 70, and then it turns off.
Right. It's just following a very basic logic gate. If X, then Y.
Exactly. But agentic AI means the software acts as an autonomous, forward-looking agent. It doesn't just react to the temperature in the room. It predictively analyzes external data streams.
Okay, give me an example of that.
Let's look at a mechanical example. The 75F software can actually connect via API to the local utility grid's pricing models and the real-time weather forecast.
Okay, wait, I need the mechanical breakdown of that. How does an air conditioner negotiate with a power grid?
All right, let's say the utility grid is forecasting a massive demand spike at 2:00 p.m. because of an incoming heat wave, and they're going to triple the cost of electricity during those peak hours.
Typical summer day in Texas.
Right. The agentic AI sees that price spike coming hours in advance. So at 11:00 a.m., when power on the grid is still cheap and abundant, the AI autonomously commands the Carrier HVAC system to blast the air conditioning, intentionally overcooling the building.
Whoa, so it's essentially using the physical mass of the building, the concrete, the floors, the air volume, as a thermal battery, just storing cold air.
Yes. It pre-cools the building while electricity is cheap. Then right at 2:00 p.m., when the utility company triples the price of electricity, the AI shuts down the heavy compressors.
Oh, that's brilliant.
The building slowly coasts on that stored thermal energy through the peak pricing window. The occupants stay comfortable, but the building owner completely avoids paying the surge pricing. The software is just autonomously negotiating energy arbitrage in real time.
That is incredible. I mean, it literally turns a piece of sheet metal and a compressor into an active participant in the energy grid.
Exactly.
But Gillen also mentioned the installation mechanics of 75F. He talked about commissioning sensors.
Right, and this is where the cost savings become exponential for Carrier's installer network. Think about the physical infrastructure of a modern office building. You might have 1,000 individual temperature, humidity, and occupancy sensors wired throughout the ductwork and the rooms.
That's a lot of wiring.
And historically, a human technician has to walk around with a laptop, manually commission, address, and calibrate every single one of those 1,000 sensors to ensure they are talking to the central computer correctly.
That must take forever.
It takes weeks of very expensive labor.
And what does 75F do differently?
It features wireless auto-commissioning capabilities. You physically mount the hardware on the wall, turn it on, and the cloud-native software automatically seeks out the sensors, identifies their location in the mesh network, and configures them without any human intervention.
No way. It just figures it out itself.
The system essentially builds its own map. It drastically lowers the labor cost of installation, which obviously makes retrofitting older buildings highly profitable for Carrier's channel partners.
Okay, as fascinating as agentic AI is, we know technology acquisitions take years to fully integrate and actually hit the bottom line.
Yeah.
The margin problem in their European segment, though, that is happening right now.
Oh, yeah. That's an immediate fire.
How is management addressing the immediate bleeding in Europe?
Well, they're executing a classic aggressive corporate maneuver, a total leadership shakeup. To fix the margins, Carrier appointed Thomas Donato as the new president of their European segment.
What is his specific mandate? Because management was very, very blunt on the call about their disappointment.
His mandate is ruthless operational discipline. The executive team stated plainly that they need to do a vastly better job on both price and cost in the European theater. And Donato is not just a random hire, you know?
Who is he?
He has a deep, deep background driving margins at major industrial players like Rockwell Automation, ABB, and Bosch.
So how does a new president actually fix a margin issue mechanically? Like, what levers does he pull?
He is being brought in to pull 3 specific levers. First, pricing discipline. When sales teams are pressured to hit volume targets, they tend to heavily discount the product just to win the contract.
Right, just to get the numbers up.
Exactly. Donato is there to stop the bleeding on discounts and ensure the sales force holds the line on premium pricing.
And the cost-cutting side.
That's the second and third levers. He is mandated to optimize their complex European supply chain and actually consolidate their manufacturing footprint.
What does that look like?
Well, if you have 3 factories running at 60% capacity, you consolidate that down to 2 factories running at 90% capacity. That way, you absorb the fixed overhead costs much better. And finally, he will be executing reductions in general and administrative expenses, basically trimming the corporate bloat.
The CEO specifically put a target on Donato's back, too. He said the expectation is to get the European business back to mid-teen operating margins over the next few years, and he expressed complete confidence that Donato will get them there.
It is a flashing red signal to the market. Management sees the margin deterioration, they refuse to accept it as the new normal, and they have literally fired and hired at the highest executive levels to force a course correction.
Which brings us to really the most critical question of this entire deep dive, going back to our restaurant analogy. If the restaurant sold too many appetizers this quarter, is that a permanent structural shift in the macroeconomic environment? Are consumers just fundamentally poorer now, permanently refusing to buy the high-margin steak? Or was this Q2 margin squeeze a weird temporary anomaly caused by tariff lags and a fluky product mix?
That's the million-dollar question. And to determine if this is a structural flaw or just a temporary blip, we have to look past Q2 and analyze exactly what management is forecasting for the rest of the year.
Their forward guidance.
Exactly. We have to look at the guidance.
Let's transition into that future outlook then. Because despite the margin hiccup we just spent 20 minutes dissecting, management actually raised the bar for the full year.
They did.
They raised their full-year sales guidance to approximately $23 billion. They raised their adjusted operating profit to roughly $3.5 billion, and they bumped their full-year EPS guidance up to $2.90.
This is a remarkably confident, honestly almost aggressive posture to take immediately after printing a quarter with a 7% EPS decline.
Right. It takes guts.
When a management team raises full-year guidance in the face of short-term margin pressure, they are putting their absolute credibility on the line. They are telling institutional investors, we understand exactly what caused the friction in Q2, we know the mechanics of how the second half of the year is going to play out, and the volume is going to be massive.
And a huge portion of that confidence seems to be anchored entirely in the data center revisions. They increased their full-year data center sales outlook to about $2 billion.
Well, which means they are doubling their sales in this specific vertical for the second consecutive year. It is textbook exponential growth. But we need to look at the timeline of that $2 billion forecast.
Right.
They noted on the call that they have already delivered roughly $500 million of that in the first half of the year.
Wait, if they promised $2 billion for the year and only delivered $500 million in the first 6 months, that implies a massive $1.5 billion ramp in data center deliveries scheduled purely for the second half of this year.
Exactly. The back half of the year is just loaded with high-margin, massive volume deliveries. And that dynamic leads directly to what management is calling the H2 inflection, or the second half inflection point.
The inflection point, right?
They are forecasting a staggering 50% year-over-year EPS jump in the second half of the year.
A 50% jump in earnings per share in a 6-month window. I mean, for a legacy industrial manufacturer, that is light speed. How do they mechanically justify forecasting that kind of leap?
They pointed to 3 distinct mechanical drivers. First, favorable volume. As that $1.5 billion in data center equipment physically leaves the factory floor, the sheer velocity of product increases.
Right.
When you push more volume through a factory, your fixed costs, the rent, the insurance, the baseline salaries, are absorbed across a much larger number of units, which mathematically improves the profit margin on every single unit.
That's driver 1. What's 2?
Second, net productivity. The ruthless cost-cutting measures and operational efficiencies that Thomas Donato and the executive team are implementing right now, those will actually start showing up on the balance sheet in the third and fourth quarters.
And what is the third driver?
The end of customer destocking.
Oh, let's unpack this term because it is crucial for anyone investing in industrial or manufacturing stocks right now. Destocking. It sounds like, a grocery store clearing out its shelves at the end of the month.
The mechanics are actually very similar, and it traces back to a macroeconomic phenomenon called the bullwhip effect in supply chains.
I want to dive deep into the bullwhip effect. Explain how that works in the context of carriers, distributors.
Sure. Let's use a traffic jam analogy. Imagine you are driving on a highway. Someone a mile ahead of you taps their brakes slightly. The car behind them overreacts and hits the brakes a little harder. The next car hits them even harder. By the time that wave of braking action travels a mile back to where you are at a complete dead stop, even though there is no actual accident ahead. The small disruption was just amplified all the way down the chain.
Wow, okay. How does that apply to air conditioners, though?
So, during the pandemic and the subsequent global supply chain crises, the local distributors of HVAC equipment, the companies that actually buy the units from Carrier and store them in local warehouses to sell to contractors, they panicked.
Because they couldn't get inventory?
Exactly. They couldn't get enough inventory from the factories because of chip shortages and shipping delays. So to protect themselves, they massively overordered. They built up massive buffers of inventory in their warehouses, just completely terrified of running out of stock. They basically slammed on the brakes.
But then the supply chains normalized. The ships started unloading. The microchips became available again.
Exactly. And suddenly, those local distributors looked around their warehouses and realized they had a massive glut of inventory. They had way too much capital tied up in metal boxes sitting on pallets.
So they stopped ordering.
Right. For the last 12 to 18 months, instead of buying new, fresh units from Carrier's factories, these local dealers have just been selling down the excess inventory they already had.
That is destocking. So Carrier feels the financial pain because their factory orders flatline, even if end consumer demand, like the homeowner whose AC just broke, remains perfectly steady. The distributor is just pulling from their back room instead of ordering from Carrier.
Precisely. Carrier's factories have been sitting in that traffic jam dead stop for a year, but management is signaling that the painful destocking process is finally over. They noted that field inventory levels, so the amount of products sitting in distributor warehouses, ended Q2 down about 25% versus last year.
Meaning the distributors have finally cleared out the backlog. The warehouses are returning to normal baseline levels.
Which means the traffic jam is clearing. Moving forward, those distributors have to start placing fresh, real-time orders with Carrier's factories again, just to meet everyday consumer demand. The bullwhip effect has worked its way through the system.
Got it.
That dynamic alone, the resumption of normal order flow, is expected to provide a massive mechanical tailwind to Carrier's second-half revenue and EPS growth.
The end of destocking, combined with a massive data center backlog, it creates a very compelling case for the second half of the year. But there is one piece of their forward guidance that I want to challenge because it seems inherently contradictory to their current margin struggles. Full-year capital expenditures, their CapEx, is expected to be $600 million.
It is a massive capital commitment, yes.
A huge chunk of that $600 million is because Carrier is aggressively planning to break ground on a brand new, massive U.S. manufacturing facility. They mentioned they are looking at sites likely in Texas or Alabama, and this facility is being built specifically to handle the projected data center cooling demand for 2027 and beyond.
That is correct. They are scaling physical infrastructure to meet the anticipated AI demand.
So here is my pushback. If they are already struggling to maintain a 17% margin today, isn't dropping hundreds of millions of dollars on a massive new factory incredibly risky right now?
It's definitely a concern.
What if the AI bubble pops? What if the hyperscalers, the Amazons, the Googles, the Microsofts suddenly decide, you know what, our AI models were efficient enough, we don't need to build any more mega data centers for the next 5 years. If that happens, Carrier is left holding the bag on a giant empty factory in Texas, and their margins will absolutely crater under the fixed costs of an empty building.
You are hitting on the exact fear that institutional investors have right now. The risk of overbuilding capacity at the peak of a cycle is a classic fatal manufacturing pitfall.
It's happened before.
It has bankrupted industrial companies in the past. And Wall Street analysts absolutely grilled management on this specific risk during the Q&A portion of the earnings call. Management is acutely aware of the danger of getting out over their skis on capital expenditure.
I understand they are aware of it, but how are they actually mitigating the risk mechanically? Like, what prevents that factory from becoming a stranded asset?
Management defended the expansion through a concept called fungibility. The CEO explained that they are designing the physical layout of this new facility and the robotics and production lines inside it with extreme modularity. They are ensuring that the manufacturing lines are highly fungible.
But isn't fungibility just a convenient corporate buzzword for, we hope we can pivot if this AI thing blows up in our faces?
I mean,
if the AI market collapses, suddenly there is a massive supply glut of cooling equipment, and every other manufacturer is going to be fighting for the exact same hospital and office building contracts. Does fungibility actually protect them?
it's a fair challenge. Let's look at the actual mechanical overlap in heavy commercial applications to see if the fungibility argument holds water. The core technology they're building for these data centers involves massive, high-tonnage, air-cooled and water-cooled chillers. If data center demand completely evaporates overnight, the engineering and the physical footprint of those chillers are not entirely unique to server farms.
Where else could they go?
A massive water-cooled chiller designed for a data center can, with relatively minor retooling on the assembly line, be adapted to provide the chilled water loops required for a massive pharmaceutical manufacturing plant, a heavy industrial complex, or a high-rise hospital network. The thermal physics are essentially transferable.
Okay, the hardware can be adapted, but what about the market demand? As you said, if everyone pivots away from data centers, the market for hospital chillers gets instantly overcrowded.
That brings us to Gitlin's second defense, which relies on an interesting market share dynamic. Carrier historically started with a relatively low market share in heavy commercial HVAC in the United States compared to some of their entrenched legacy peers like Drain or York.
I need to understand how having a low market share is a defense mechanism.
Let's use a hypothetical baseline. Let's say Carrier historically only controlled 10% of the U.S. heavy commercial market, while a main competitor controlled 30%. Right now, because of their technological advancements and aggressive sales strategies, Carrier is rapidly taking market share from those competitors.
They're eating their lunch.
Exactly. Because they are starting from a smaller baseline, their growth runway is much longer. Even if the overall macroeconomic pie of capital expenditure shrinks slightly, say fewer hospitals are built next year, Carrier's specific slice of that pie is growing so fast that they will still need the physical factory capacity just to maintain their new, larger share of the consolidated market.
Oh, see.
They are mathematically protected by the velocity of their own market share gains against their competitors.
That makes sense. They are eating the competitor's lunch fast enough to justify the kitchen expansion, even if the restaurant gets slightly less busy overall. Furthermore, they aren't just building this factory on speculative hope. They explicitly mention securing long-term agreements, or LTAs, with the hyperscalers.
Defining hyperscalers is critical here. We are talking about the apex predators of the cloud computing world. Amazon Web Services, Microsoft Azure, Google Cloud, Meta.
The giants.
These are entities with near infinite capital. When Carrier says they are signing LTAs, they mean these hyperscalers are contractually committing to purchase a baseline volume of cooling equipment extending out to 2027, 2028, and 2029.
They are essentially guaranteeing the revenue before Carrier even pours the concrete for the factory in Texas.
Precisely. Because right now, the hyperscalers are terrified of one specific bottleneck: thermal management. In the AI arms race, speed to market is everything. You can buy all the $40,000 NVIDIA GPUs in the world. You can secure the land for the data center. You can get the permits from the local utility to draw the power.
But if you can't cool it,
But if you cannot physically remove the massive amounts of heat generated by those chips, the silicon will literally melt. They are entirely dependent on liquid cooling distribution units and massive air-cooled chillers. The hyperscalers are signing these LTAs because they are locking down their supply chain. They are securing Carrier's manufacturing capacity for themselves to ensure their competitors don't get it.
So we've dissected the headline numbers, we have diagnosed the mechanical friction causing the margin squeeze, and we have stress-tested management's aggressive guidance and capital expenditures. What does all this data actually mean for you, the listener, and your portfolio? Let's distill this entire complex ecosystem into an actionable bottom line.
We need to render a verdict. When you synthesize the Q2 margin disappointment against the massive forward-looking backlog, are these earnings a bullish or a bearish signal for the stock?
Where do you firmly land on this?
I am taking a decisive position here. Despite the very real margin noise in this specific 90-day window, this quarter represents a strongly bullish signal for the stock over a multi-year time horizon.
Okay, defend the bull thesis. Make the case for why an investor should overlook a 7% drop in earnings.
Let's systematically address the negatives first. The margin issues are frustrating, absolutely. No investor wants to see profitability slide. But when you look at the mechanics, these are highly addressable, temporary growing pains.
Like the tariffs.
Right. The tariff timing lag, where they had to absorb the cost of materials before their price hikes took effect, is a self-resolving mathematical issue. As the new price sheets fully integrate into the distribution channel in Q3 and Q4, that margin drag just vanishes.
And the product mix.
The unfavorable product mix is also expected to normalize. As the new construction backlog clears and high-margin residential emergency replacements pick up in the back half of the year, the profit ratios will balance out. And most importantly, management is not sitting passively hoping things improve.
Right, they hired Donato.
Yes, they are aggressively attacking the European cost structure by installing new, ruthless leadership in Thomas Donato to force operational discipline.
So the negatives are mechanical, temporary, and actively being managed. What are the structural positives that drive the bull case?
The macroeconomic tailwinds behind Carrier right now are, quite frankly, generational. First, you have the data center hyperscaler demand, which we've exhausted. A 400% increase in orders and an $8 billion backlog is an absolute juggernaut of guaranteed future revenue.
It's massive.
But we cannot overlook the structural shift happening in Europe.
Right, let's talk about the European energy grid. The earnings transcript noted that European heat pump orders were actually up 20% in the quarter. Given all the economic turmoil in Europe right now, why are heat pumps suddenly surging?
If you connect the hardware data to the broader geopolitical picture, Europe is currently undergoing a fundamental forced restructuring of its entire energy grid. It's largely in the wake of the war in Ukraine and the resulting natural gas crisis.
So they're trying to get off gas.
Exactly. Nations are aggressively trying to decouple from imported fossil fuels.
And mechanically, how does that favor a company like Carrier?
It comes down to the ratio of natural gas prices to electricity prices. Even with fluctuations, the macroeconomic policy direction strongly favors electric heat pumps over traditional gas boilers. Germany, which is a massive, highly influential market, has recently recommitted to heavy government subsidies for residential heat pump installations to drive adoption.
And Carrier specifically tailored their product line to capture this subsidized demand. On the call, they talked about launching a new product in Europe, the Vidicold 200.
Yes, this is being launched under their Viessmann brand, which is a highly respected European manufacturer they recently acquired. The Vidicold 200 is strategically crucial.
Why is it so important?
Historically, Viessmann built ultra-premium, highly expensive units. The Vidicold 200 is a slightly more affordable tier of premium heat pump. It is designed to hit the specific price point that maximizes the government's subsidies for the homeowner.
Ah, smart.
By introducing this tier, Carrier significantly increases their total addressable market. They're expanding their reach beyond just wealthy German homeowners to middle-class retrofits in massive markets like Poland and Italy.
Beyond just government subsidies for heating, they also mentioned a cultural shift happening regarding cooling in Europe. They noted that the extreme sustained heat waves over the last few summers are fundamentally shifting European attitudes toward air conditioning.
Historically, there has been a strong cultural and architectural resistance to installing traditional air conditioning in European schools, hospitals, and historical residential buildings.
It was viewed as an unnecessary American luxury, basically.
Pretty much. But with record-breaking temperatures becoming the annual norm, that resistance is rapidly breaking down.
It's moving from a luxury upgrade to a fundamental life safety necessity for vulnerable populations.
Exactly. The mechanical infrastructure of entire cities is having to adapt to new climate realities. When you combine the geopolitical structural shift away from fossil fuel boilers toward electric heat pumps, the rising climate-driven penetration of traditional air conditioning in Europe, and the absolute insatiable need to pump liquid coolant through AI data centers globally, the foundational baseline demand for Carrier's core engineering expertise is absolutely ironclad.
So condensing all of this down to the actionable takeaway for the listener managing their own portfolio.
If you currently hold the stock, the long-term thesis remains completely intact. The noise around a 17.2% margin in one isolated 90-day window does not derail a multi-year, multi-billion-dollar supercycle in global infrastructure spending.
Don't let it shake you out.
Right. Do not let short-term, easily explainable volatility shake you out of a fundamentally strong, highly visible position.
And what if you were currently on the sidelines? What if you were considering adding TRR to your portfolio, but you were, spooked by the initial earnings headlines?
Then, any short-term dip in the stock price caused by Wall Street's algorithmic disappointment over these temporary margin issues represents a classic textbook buying opportunity.
Buy the dip.
Exactly. You are being handed a chance to buy into a company that is fundamentally so strong, it is raising its full-year profit guidance, but you are getting it at a potential discount simply because the broader market is hyper-focusing on temporary tariff lags and a fluky 90-day product mix. It is a moment where understanding the underlying mechanics of the business gives you an edge over the headline readers.
That is a highly compelling mechanics-driven case. And it brings me to a final provocative thought that I want to leave you, the listener, with today. Something to mull over on your own that builds on everything we've dissected in this report.
I'm intrigued. Where does this all lead?
Well, when we hear the phrase AI revolution in the financial media, our minds immediately jump to the sexy, highly publicized technologies. We think of microscopic semiconductor chips designed by NVIDIA. We think of massive software algorithms coded by OpenAI. We think of robotic automation.
Slashy stuff, yeah.
We look for the most advanced, futuristic companies to invest in. But based on Carrier's staggering $8 billion backlog, based on the fact that the most powerful tech companies on Earth are signing contracts years in advance just to secure cooling capacity, and based on Carrier's urgent scramble the jets need to build massive new factories in Texas just to keep those servers from physically melting down. Could it be that traditional, unglamorous, heavy metal HVAC companies are secretly the safest, most overlooked way to invest in the entire AI infrastructure supercycle?
Wow. It is the ultimate evolution of the classic pick and shovel investment strategy.
Right.
During a gold rush, the riskiest investment you can make is betting on the individual gold miners who are out there digging in the dirt. Most of them will strike out and go bankrupt. The safest, most profitable investment is being the guy selling the shovels to every single miner who walks into town.
Exactly. The AI software companies, the Googles, the Microsofts, the well-funded startups, they're going to battle it out in a brutal war for supremacy. Some will win massive fortunes, many will fail completely. But no matter whose specific large language model wins, no matter whose software becomes the global standard, every single one of those servers is going to run incredibly hot.
They're all going to need it.
They will all need complex liquid cooling distribution units. They will all need massive air-cooled chillers pumping thousands of gallons of chilled water through their server racks 24 hours a day, 7 days a week.
And tying it all back to the diagnostic puzzle we opened the show with, sometimes the clearest financial x-ray of the AI boom isn't found by looking through a microscope at a silicon chip. Sometimes the clearest indicator of where the money is flowing is a massive 3-ton industrial air conditioner sitting on the roof of a data center in Texas.
A perfect place to leave it. We want to thank you for joining us on this incredibly Deep Talk Tickers edition of The Deep Dive. We hope we provided you with the mechanics and the context you need to look past the headlines. Keep asking the hard questions, keep demanding to know how things actually work, and keep digging into the numbers. We'll catch you on the next one.